Welcome. I've introduced you to T accounts before, but in this video I'm going to show you one of the reasons I really like T accounts. That's that, to me, they facilitate a way to think about understanding the history of what's gone on in a balance sheet account. That's a question you're often going to ask: why did an account change? Another way to think about this is, why did that snapshot in time that I'm seeing change from the last snapshot in time? Balance sheet accounts are really helpful because of the fact that they capture that snapshot in time, but there's sometimes when you really do want to understand their evolution. For example, imagine that you were looking at a company's financial statements and you noticed their inventories increased. You want to try to figure out, did they buy more inventory during this period, or did they just use less of it up? If they bought more inventory, that might be a good sign. That could indicate that, in fact, they're building up for big growth that they expect in the future. On the other hand, if they used up less inventory during this period, that might indicate that they're having a hard time making sales. You can see that that increase in inventory can actually provide two different sorts of signals. In one case, it's a positive signal, we're going to have future growth. In another case, it's a negative signal, we're going to have a decline in the future. Let's think of another question. Maybe the accounts receivable balance was shrinking for the company. You're trying to figure out, is this because sales are down and the company's really heading into a slump? Or is this because they have faster and more effective collections? We can look at the evolution of the account again to get some better sense of what's going on in the company. If credit sales are shrinking, this might indicate a weakness in the future, versus if they're more effectively collecting on their accounts, that might tell us that they've enhanced their operational efficiency. Now, both of those are examples where you're outside of a firm trying to get some sense of what's going on inside. So maybe you aren't able to get private reports. But even inside the firm, there are times when you'd want to look at a simple change in the accounts in order to get some sense of what's going on. Maybe you're concerned you have an operational issue or some sort of error has been made, and you want to test that by looking at how your accounts evolved over time. Think about the question of whether somebody's stealing cash. By looking at the account, you might be able to get a sense of where's the cash disappearing or what's going on with it. Let me show you how you can use the T account to do this. Remember, when we have T accounts, they just look like a T with some sort of title at the top. If you have an asset T account, then you're always going to have a beginning balance on the debit side. That's the left-hand side. And when something gets added to the account, that's also going to be a debit. And then when something gets taken out of the account, that is, it gets used up, that's going to be a credit, so it's going to go on the right-hand side. And that's going to bring us down to the ending balance of the account. If you think of a liability account, it looks pretty much the same as far as the T account. It's just the mere opposite of it. So the beginning balance, the additions, and the ending balances are all on the credit or right-hand side. And the things that left the account are on the left-hand side now, or the debit side. Let's take an example of looking at how we can use this structure to get a better understanding of what's going on. We'll return to our inventory example. So you can get the beginning and ending inventories off of the company's balance sheet. You can go to the income statement and get the cost of goods sold. Now, what you're trying to figure out is, what were their purchases during this period? Was it that buildup that's really driving the growth in the inventory account, or was it a decline in cost of goods sold? Of course, those two things are relative, which is why we need to know the purchases. How does the structure that we see in the T account help us to answer this question? Well, it really makes clear to us the relationship between the beginning balance, the cost of goods sold, the ending balance, and this purchases number that we're trying to understand. It gives us a way to put together an equation to solve for purchases by showing us that purchases are equal to the beginning balance, everything we had, plus the cost of goods sold, everything that we took out of there, minus whatever's left over at the end of the period. In doing this, we can get this purchases number, compare it to last year's purchases number, and compare the cost of goods sold across the two periods from the income statement. That's going to give us some sense of whether inventory is growing because of increased purchases or because of declining sales and declining cost of goods sold. It's an ad hoc approach, I get that, but it's a good first step towards developing understanding. Once you have some sense of whether purchases have increased during the period or whether they're relatively flat, you'll ask different questions of the company as you try to understand the company more. Let's take a look at that petty cash example. Remember there, we're working inside the company, but we're concerned that somebody may be stealing some of our cash. So how do we go about capturing that? Well, again, we'll start with the beginning and ending balances. In these situations, we may just count that cash ourselves at the beginning of the period and again at the end of the period. Or maybe the cash is in a bank, so instead of us counting it, the bank counts it. But it should be pretty easy for us to get those beginning and ending numbers. Now, as receipts came in, again, we would have counted those and put those into our system, or they would have come into our bank and our bank would have counted those. So we feel comfortable that we have that number as well. What we need to solve for here are the disbursements, what went out of the company. And as we look at the structure, we can do the same sort of thing we did last time. We can put together an equation using the T account, which will help us to understand that disbursements equals the beginning balance plus all the receipts that came in minus the ending balance. Now, once we've done this, we can compare that computed disbursements number to the authorized disbursements by going back and looking at all the different things that the company actually approved people could do. We can get that authorized disbursement number by looking at all of our journal entries from the past. If we find that our authorized disbursements don't match our computed disbursements, it tells us we may have a cash problem. It doesn't tell us who took the cash or how it was taken, but it does indicate that an investigation is needed. Both of these are just simple examples of how breaking down the evolution of a balance sheet account can help you to understand the company. They also show you how the T account structures it so that you can more clearly think about what's going on into the account. It's kind of like a cheat sheet that just makes sure that you don't, in a rush, make some sort of an error. I hope this shows you another good reason to get familiar and comfortable with T accounts.